Hi, this is Mark Fleming, President of Signature Closers. Today I'd like to spend just a few moments of your time to review some of the changes coming to our industry as a result of the Consumer Financial Protection Bureau and the integrated mortgage loan disclosures. For many loans that are set to originate on or after October 1st, 2015, there will be changes in regards to the documents supplied at closing, as well as some other process changes. Today we'll talk a little bit about what those changes are, as well as the timelines associated with each of those changes. So as far as an overview, we're going to go over the history of the Truth in Lending Act as well as the Real Estate Settlement Procedures Act of 1974, the Dodd-Frank Act, and then also talk about the Consumer Financial Protection Bureau and its creation. We're going to look at new disclosures versus old disclosures, types of loans impacted by the new legislation, as well as the loan estimate and closing disclosures, some timelines, delivery, confirmation, and how that happens, and then also some frequently asked questions. So looking back at the history, the Truth in Lending Act, otherwise known as TILA, and the Real Estate Settlement Procedures Act of 1974, also called RESPA, had created two separate required disclosures with overlapping and inconsistent language that would be provided to a borrower at the time of their initial loan application. Additionally, there's two disclosures provided at the closing table, the Truth in Lending form as well as the HUD-1 settlement statement that are part of or under these acts. On July 21st, 2010, Congress signed into law, or the President signed into law, the Dodd-Frank Wall Street Reform and Consumer Protection Act, otherwise known as the Dodd-Frank Act. Within this law, the Consumer Financial Protection Bureau, or CFPB, was created as a government agency with a number of directives, obviously to protect consumers within financial transactions, and one of those objectives was to create rules and model disclosures that integrate the TILA and RESPA disclosures by July 21st, 2012. Originally, the Consumer Financial Protection Bureau was going to be rolling out the industry changes on loans originating on or after August 1st, 2015. However, on June 17, 2015, the CFPB announced a delay in this implementation period so that now only loans originating on or after October 1st, 2015 will be subject to the new legislation. We do believe that there will be a negative impact, unfortunately, on October and November closing volume. The good news, I guess, from the perspective of the delay is that hopefully title companies and lenders are more prepared for these changes, which should minimize some of these impacts. And we also wanted to point out there will be an overlapping time frame where some of the old disclosures, the HUD-1, the Truth in Lending statement and form will actually still be in play, as well as the new disclosures, because there will be loans that originate, September 30th, 2015, as well as loans that originate October 1st, 2015, and those forms will be different. And one note we do want to point out as well is title companies are not permitted to use the new disclosure forms on any loans originated prior to October 1st, 2015, even if they are prepared to implement the new forms prior to October 1st, 2015. So you will not see any of the new disclosure forms in place until loans have begun to originate on October 1st, 2015. So I'd like to spend just a couple of moments reviewing the new disclosures and comparing them to the old disclosures as they stand today. So in today's environment, we have a good faith estimate and a preliminary truth in lending form that's provided to the borrower at the initial disclosure. And then at the actual closing table, we have a final truth in lending form and then the HUD-1 or settlement statement as it's known. On or after loans originating October 1st, 2015, and again, it's most loans. There are some loans that will not be subject to these changes, which we'll review in a bit, but most loans will actually see the good faith estimate and the preliminary truth in lending will be replaced by the loan estimate form during the initial disclosure period to the borrower. And then at the final closing table, the truth in lending and HUD-1 or settlement statement are going to be combined and replaced by the closing disclosure at the closing table. One of the questions that we're still looking for guidance on is what's going to happen with the non-borrowing spouse in the closing disclosure. In many states today, the non-borrowing spouse will sign the truth in lending form, but they do not typically sign the HUD-1 settlement statement if they are not on the loan. So we are looking for a little bit of guidance, and we'll share that as soon as we have an answer to that question. So which loans are actually impacted by these changes? All loans originated on or after October 1st, 2015 will be subject to the new disclosures and timelines with the exception of home equity line of credit loans, reverse mortgages, Mortgages secured by a mobile home or by a dwelling that is not attached to real property or not attached to the land. There will be a partial exemption for certain transactions associated with housing assistance loan programs for low and moderate income consumers. Timeshare loans will have slight variations in the rules and timelines associated with those loans. And then loans made by persons who make 5 or fewer mortgages in a year are also not subject to these new disclosures. One of the other noticeable missing types of closings would be a cash closing because clearly there is no loan, so they would not be subject to this legislation as well. So let's talk a little bit about the loan estimate form. The loan estimate form, as mentioned, will replace the preliminary truth in lending and good faith estimate in today's initial disclosure package sent to the borrowers after they apply for a loan. And a little bit later, we'll talk about what information triggers the requirement that this disclosure package must be sent to the borrowers. Today, and as well with this new form, this package must be provided to the borrower no later than 3 business days after they submit a loan application. And for purposes of the loan estimate form, business days are going to be defined as a day on which the creditor's office are open to the public for carrying out substantially all of its business functions. So more and more banks are open on Saturdays. I know a lot of the local banks here in Central Ohio, Huntington Bank, PNC and others are open on Saturday, so therefore a business day would be defined as including Saturday under this definition. However, you're going to find that the definition of business days will be determined a little bit differently on the closing disclosure form, and we'll talk about that momentarily. As far as delivery of the loan estimate form, as you might imagine, creditors are responsible for ensuring that this form is provided in a timely manner that meets the delivery requirements as set forth under the law. Mortgage brokers are able to provide the loan estimate form on behalf of the creditor, but the creditor is still ultimately responsible to make sure that form is delivered. Delivery confirmation to the borrower occurs when there's proof of delivery. That can include a signature confirmation or some other type of electronic signature. Or delivery confirmation can be assumed 3 business days after placing the information in the mail or sending an email. Today, lenders are showing a bit of an interest in having these initial disclosures collected by notary signing agents, and this is a service that lenders have asked us to perform most recently. And the question would be why? Well, first off, it increases the likelihood that the loan is going to close if you have a representative for the lender in front of their potential borrower. And secondly, it also prevents the borrower from procrastinating on this paperwork, and that's going to help minimize the timeline where other lenders can present the borrower with other competitive offers or other loans. And one thing we need to be clear about is notary signing agents are not there to answer questions in regards to the loan itself. You can simply point out terms on the paperwork, you can point out signature lines, but you cannot answer questions. We're not licensed mortgage originators. We don't have an NMLS number. It's very important to note that distinction. So let's talk a little bit more about the closing disclosure form. The closing disclosure form is going to be the document or documents that replace the TIL and HUD-1 settlement statement at today's closing. These documents must be provided to the borrower no later than 3 business days before consummation of the loan. And obviously you're going to ask, what is consummation of the loan? What does that mean? Is it the same thing as closing? Well, consummation occurs when the consumer becomes contractually obligated to the creditor on the loan, not necessarily when they're contractually obligated to a seller. So the point in time when a consumer becomes contractually obligated to the creditor is going to be dependent on applicable state law. That's something that creditors and settlement agents are going to be verifying, obviously in their respective states. For our purposes, we can consider that generally the consummation of the loan is going to occur the day of closing. So we'll look at it that way when we look at timelines and delivery requirements. But again, that may vary by state. But for today's purposes, we'll assume it is the day of closing. For purposes of the closing disclosure form, a business day is actually defined as meaning all calendar days except Sundays and the legal public holidays set forth below. So you'll notice the closing disclosure business day definition actually mirrors the business day requirement for the right to cancel at closing. And that is something that obviously, makes sense, but also something to keep in mind. Ultimately, again, creditors, as we've seen before and seen time and time again on real estate transactions, they're responsible for ensuring that this disclosure form is provided in a timely manner. However, title companies or settlement agents, may provide the closing disclosure form on behalf of the creditor, but the creditor still maintains that ultimate responsibility to make sure it's done correctly and appropriately. There are a number of acceptable delivery methods. The first would be providing it in person to the consumer, which obviously, it's considered received at that point. You can also mail or provide other delivery methods such as email, and they may use electronic delivery methods subject to compliance with the consumer consent and other applicable provisions of the Electronic Signatures and Global and National Commerce Act. What does that mean? Basically, that means creditors will have to get prior consent from borrowers to obtain electronic signatures. They will need to abide by any legislation or any laws as outlined below in the Electronic Signatures Act. When is the delivery of the closing disclosure form considered to be received by the borrower? If the form is provided in person, as I previously mentioned, it's considered received at that time. If the form is mailed or delivered electronically, it's considered received 3 business days after it's delivered or placed in the mail. So what that means essentially, and we'll talk about this on the next slide, is that it's going to create a longer wait period or longer window of disclosure if you don't have some type of confirmation. So if the creditor does have evidence that the consumer received the disclosure earlier than 3 business days after it is mailed or delivered electronically, it can rely on that evidence and consider it to be received on the date that it has that evidence. So what does this mean for settlement dates and timelines? If the closing disclosure is provided by regular mail or regular email without a way to confirm receipt sooner than 3 business days after it is sent, the actual disclosure period increases to 6 business days until it is considered received. So for example, suppose a title company would like to close a loan on Friday, October 30th. The closing disclosure must be received by Monday, October 26th to meet this new requirement. Remember, Sundays and national holidays are excluded as business days. So if the title company sends the disclosure form by regular mail or email without any delivery confirmation, then the closing disclosure must actually be mailed or emailed by Thursday, October 22nd to meet the new requirement. So what can title companies do to avoid a prolonged wait period to close? One option they have is they could hand deliver the closing disclosure to the borrower. We believe a lot of title companies will steer clear of this method just due to the cost involved, but if they do go this route, we would recommend developing a document that the borrower signs to confirm receipt of the closing disclosure that's witnessed preferably by a notary. Another option would be to send the closing disclosure form using FedEx or UPS with delivery confirmation services. And one of the things we believe title companies or anyone else should consider would be using a signature delivery confirmation as opposed to just a delivery confirmation without signatures. Obviously, the more evidence you have that it was received by the borrower or by the consumer, the better it will be for you in terms of proving that you did deliver the document. Another alternative would be to deliver this form with a closing or with an electronic delivery system rather. And our recommendation would be at minimum to utilize a system that provides delivery confirmation so that you can actually see the date and time when the borrower opened the email. And then probably taking it a step further, it would make sense to have a date timestamp activity log of when they actually downloaded the disclosure form, which is something that is available. An even better solution, in our opinion, would be to have the recipient electronically acknowledge receipt of the closing disclosure form. You could date timestamp that as well and track that it's been done. And of course, it does need to meet applicable laws that are out there regarding electronic signatures. So a couple of things that we'd want to go over. What if the closing disclosure form is incorrect and needs to be revised? Well, there's 3 categories of changes that may require a corrected closing disclosure. The first would be something that occurs before consummation that requires a new 3 business day waiting period. The second would be something that occurs before consummation but does not require a new wait period. And the third would be any changes that occur after consummation. We're not going to spend a lot of time discussing those, as obviously there will be something that the title company needs to do to send out a new disclosure and make these changes aware, or changes, put them in front of the borrower, I should say. But we'll spend a little bit more time looking at the changes that occur before consummation. So what changes require a new 3 business day waiting period? If the disclosed APR, annual percentage rate, becomes inaccurate, that would be one. Number 2 would be the loan product changes. So you move from maybe a fixed rate mortgage or loan to an adjustable rate mortgage. The third alternative that may require or does require a new 3 business day waiting period would be a prepayment penalty being added to the loan. All other changes do not require an additional 3 business day waiting period. The creditor must ensure only that the consumer receives the revised closing disclosure at or before consummation in those situations. Some other frequently asked questions that we've had. So, what if the borrower requests a copy of the revised closing disclosure before closing? So, you're in a situation where there hasn't been a change to the APR, the loan product, or the prepayment penalty situation on the loan. The creditor is not required to provide the consumer with the revised closing disclosure until the day of consummation. However, a consumer does have the right to inspect the closing disclosure during the business day before consummation. If a consumer asks to inspect the closing disclosure the business day before consummation, the closing disclosure presented to the consumer really just needs to reflect anything that the lender or the creditor would be aware of at that time. So any adjustments to the cost or terms that are known to the creditor at that time must be included on that closing disclosure provided the day before consummation. Another question, what if there's more than one consumer involved in a loan? Who has to get the closing disclosure? In rescindable transactions, which obviously most of our refinances will fall under that umbrella, the closing disclosure must be given separately to each consumer has the right to rescind under TILA, although the disclosures required for adjustable rate mortgages need only be provided to the consumer who expresses an interest in a variable rate loan program. In addition, if there's transactions that are not rescindable, the closing disclosure only needs to be provided to any consumer with primary liability on the loan obligation. So we had talked about earlier there's certain information that can be collected by lenders that triggers the loan estimate form delivery requirement, that 3-day window after their initial application. And you'll see the information includes the name, the income, and the social security number of the consumer, as well as the address of the property, the estimate of the value of the property, and then the amount that they'd like to seek in a mortgage loan. Well, previously, there was a very vague, subjective seventh alternative requirement where any other information a creditor or lender deemed necessary to determine the creditworthiness of a borrower could be required before they would be considered to have to issue that disclosure paperwork. You'll notice that's absent from the new requirements. So a big change, and it's also a question that a lot of lenders are trying to answer today, how they're going to manage that. You could have a loan officer at a bar with a friend and that information's provided to the loan officer. How's that being tracked? That technically triggers the disclosure period. So there are a lot of questions in this area and a lot of compliance concerns. So what is Signature Closers doing to ease this transition? We're doing a number of things. Obviously, we're providing education, as you can see through this PowerPoint. We're providing notary signing agent education and webinars. We're hoping to do at least quarterly webinars to go over some of the new laws, legislation, and the impact of that on our business and yours. We're also going to be developing a portal where title companies and settlement agents can submit closing disclosure forms for delivery to their clients. We're going to include electronic signature confirmation, email delivery confirmation, FedEx and UPS delivery confirmation, which can include signature or no signature required. And we'll also provide hand delivery services by notaries where the notaries will provide, notary signing agents will provide the document to the borrower, excuse me, and then receive some type of document in return verifying delivery. Our goal would be to have our portal include a date and timestamp of all activity related to the disclosure delivery process. We also want to allow title companies to view the status of closing disclosures on all of their closings, provide email notifications, and then also make that information available in perpetuity for review and audit purposes. We've provided some additional resources below for you as you look to learn more about these changes and the impact they'll have on your day-to-day business. We have a sample closing disclosure form that you can review. We have a sample loan estimate form that you can review. And then the National Notary Association has put together TILA, RESPA integrated disclosure training as well. So we've provided a link to that. Hopefully you can take advantage of these resources and further your growth and education in this way. If you have questions or comments, please feel free to reach out to us at any time. We're obviously here to support you in your growth and in your education with all of these changes. And we're excited to take on these challenges as opportunities at our business. So we appreciate your time and we look forward to providing more information in the future. Thank you.